So if you just read the top-line summary hitting your newsfeed today, you might assume Danaher Corporation is, kind of struggling to find its footing right now.
Right. I mean, the surface-level metrics look a bit rough.
Exactly. They just posted a second quarter where their bioprocessing division, which is historically one of their most crucial growth engines, it missed expectations by roughly $60 million.
Yeah, that's a number that immediately makes analysts nervous.
Oh, totally. And on top of that, their headline revenue growth across the entire company was just this seemingly sluggish 3%.
Okay.
So you look at that and think, okay, this medical conglomerate is in trouble post-pandemic.
But then you look at what management actually did with their capital.
Right. They confidently dropped nearly $1 billion to buy back their own stock. And they raised their earnings guidance for the rest of the year.
It is a fascinating contradiction on paper. You have these surface-level metrics that just scream caution, right?
Yeah.
But then that's layered over this aggressive capital deployment that screams, extreme internal confidence.
Welcome, everyone, to a very special Talk Tickers edition of The Deep Dive. If you're managing your own portfolio or, just trying to understand the macroeconomic pulse of the healthcare sector, our mission today is to reconcile that exact contradiction.
It's going to be a fun one to unpack.
Definitely. We are taking the Danaher Corporation Q2 2026 earnings, call ticker symbol DHR-R, and we are going to extract the signal from the noise. We're going to hit the headline numbers, the real story driving them, the blindness, and the bottom line.
And we aren't just going to read you a summary.
No, not at all. We are going to tear apart the underlying mechanics of the global scientific supply chain. We want to show you exactly why this quarter played out the way it did.
And honestly, Danaher is just the perfect lens for this kind of analysis because they aren't a traditional pharmaceutical company,
Right. They aren't trying to develop a single blockbuster drug and hoping it passes trial.
Exactly. They are a conglomerate that provides the picks, the shovels, the microscopes, and the manufacturing infrastructure for almost everyone else in the life sciences space.
They sell the tools for the gold rush.
That's exactly it. So when you look at Danaher's order book, you are literally looking at a leading indicator for the entire biotech industry.
So let's jump straight into the data, because I want to start with the headline numbers. This is where that initial friction lies.
The 3% growth.
Right. For Q2 2026, Danaher brought in sales of $6.3 billion. Adjusted earnings per share came in at $1.94.
Which is solid.
Yeah, very solid. Their gross profit margin is sitting at a very healthy 57.6%. But the number that I zeroed in on immediately, the one that completely changes how you view that 3% revenue growth, is their free cash flow.
Oh, the free cash flow was incredible this quarter.
Right. They generated $1.3 billion in free cash flow in a single quarter. That brings their year-to-date total to $2.4 billion.
That is the metric that institutional investors are just obsessing over right now. And it's not just the sheer volume of the cash, it's the efficiency.
The conversion ratio.
Yes. Management highlighted a 124% free cash flow to net income conversion ratio.
Okay, I want to piece this together for you listening, because on its face, a 124% conversion ratio sounds, mathematically impossible.
It does sound like a typo when you first hear it.
Right. Because net income is supposed to be your bottom line profit. So if a company reports $100 million in net income, how on earth do they put $124 million of actual cash into the bank account?
It's a great question.
Are they just aggressively delaying payments to their suppliers while demanding immediate cash from their customers?
Well, working capital management is definitely a piece of that puzzle. If you can stretch your accounts payable, meaning you take, say, 90 days to pay the company supplying you with raw materials, but you tighten your accounts receivable so your customers have to pay you in 30 days, you create this structural cash flow.
You're basically operating with other people's money for 60 days.
You are essentially operating with other people's money. Yeah. And Danaher's operational efficiency, which is heavily driven by the Danaher business system, it allows them to optimize those cash conversion cycles relentlessly.
Okay, but that can't account for a 24% premium over net income on its own, right?
Yeah.
There has to be some accounting mechanism at play here.
You're exactly right. The biggest driver of a ratio over 100% usually comes down to non-cash expenses.
Like depreciation.
Specifically depreciation and amortization. conversion. Because net income is kind of an accounting fiction, in a way. It's designed to match expenses with revenues over time.
Okay, break that down for me.
Sure. So if Danaher built a massive manufacturing facility 5 years ago for $1 billion, they don't take a $1 billion hit to their net income in year one.
Right, that would wipe out their earnings entirely.
Exactly. So they spread that cost out, right? Taking a depreciation expense of, say, $50 million a year for 20 years.
Ah, I see. So that $50 million reduces their reported net income on paper today, which lowers their tax burden, but they aren't actually writing a physical check for $50 million this year.
Precisely. The cash is still in the building, so to speak.
Wow. Okay.
Yeah. When a company is highly capital intensive in its early stages, but then reaches scale, you often see depreciation expenses artificially suppressing net income relative to the actual cash being generated.
And Danaher is definitely heavily scaled.
Right. They are a highly mature compounding machine. So a 124% conversion ratio tells you that their earnings quality is just pristine.
They aren't relying on accounting gimmicks to show a profit.
No, not at all. Their operations are throwing off vast sums of tangible liquidity.
Which gives them incredible defensive padding. Like, if the macro environment turns hostile, they have the cash pile to survive.
Or if asset prices drop, they have the war chest to acquire competitors on the cheap.
Exactly. Now, let's reconcile this massive cash generation with that sluggish 3% top-line core growth. Because reading through the transcript, management was quick to point out a metric they call core growth, excluding respiratory testing.
This is a crucial adjustment, and honestly, it's one we see across the entire diagnostic sector right now.
I look at it like receding floodwater. During the peak of the pandemic, companies like Danaher experienced a massive, unprecedented flood of revenue from COVID PCR and antigen testing.
It was a torrential downpour of cash.
Right. Now, those floodwaters are rapidly receding as we move further away from the crisis. If you just look at the overall water level, the total revenue, it looks like it's dropping, or at best, stagnating.
And people assume the receding water is going to reveal a ruined foundation, right?
Exactly. But if you actually strip away the respiratory testing drag, if you look at the foundation itself, Danaher's core business grew 4.5% in the second quarter.
And importantly, that 4.5% is a 150 basis point acceleration from their first quarter growth rate.
So the underlying engine is actually speeding up.
Speeding up significantly. The market often struggles to separate a temporary expected decline in a specific product line from, systemic weakness.
Right, because Danaher knew the respiratory revenue would evaporate.
They planned for it completely. What matters is how the non-pandemic portfolio is performing, and that portfolio is accelerating.
That perfectly transitions us to the real story behind the numbers. Because I want to know what is actually driving that foundational acceleration.
It's a great story.
Yeah, if we look at their life sciences division, management stated they just had their strongest quarter in several years. And the transcript highlights some very specific, highly technical product launches that are fueling this.
Some really cutting-edge stuff.
Let's dig into a few of these, starting with a company under their umbrella called Cytiva. They launched something called the Biacor 8S SPR system.
This is a fantastic example of where Danaher allocates its R&D capital. So SPR stands for surface plasmon resonance.
Okay, you're going to have to translate that for me.
No problem. To understand why this is driving revenue, you have to understand the main bottleneck in modern pharmaceutical development today.
Right, because finding a new drug isn't just like mixing chemicals in a beaker anymore.
Far from it. It's sifting through millions of potential molecular compounds to find the one single structure that might successfully bind to, say, a specific cancer protein.
Without destroying the healthy cells around it.
Exactly. It is the ultimate needle in a haystack problem.
Okay, so how did we historically test for that binding?
Well, historically, testing whether a drug molecule binds to a target required you to physically tag the molecules with fluorescent dyes or even radioactive isotopes.
Wow, radioactive isotopes.
Yeah.
Just so you could see the reaction happening.
Yeah, exactly. So you could visualize it under specialized imaging. It was slow, it was incredibly expensive, and here's the worst part. Sometimes the act of attaching the dye actually altered how the molecule behaved.
Oh, I see. Because you're adding a bulky dye molecule to a tiny drug molecule.
Right. So it might give you false results. The drug might have worked, but the dye ruined it.
So how does this new SPR technology solve that?
Surface plasmon resonance is an advanced optical technique that measures binding in real time. Completely label-free. You don't need any dyes.
Okay. How does that actually work physically?
You essentially attach your target protein, like the disease you want to cure, to an incredibly thin layer of gold on a glass sensor chip.
Oh, okay.
Yeah, a tiny film of gold. Then you flow the potential drug molecules over that surface, and at the same time, you shine a light at a specific angle through the glass.
And what does the light do?
Well, as the drug molecules bind to the target proteins, it microscopically changes the mass on the surface of the gold.
And that tiny change in mass alters how the light reflects.
Exactly. It changes the refractive index. The machine measures that microscopic shift in the light angle in real time.
That is wild.
It is. And it doesn't just tell you if the drug binds, it tells you exactly how fast it binds, how strong the connection is, and how quickly it detaches.
Kinetics of it.
Yes, this is called binding kinetics, and it is the absolute holy grail for a pharmaceutical researcher trying to optimize a drug candidate.
Okay, so the technology itself is brilliant, but the transcript specifically emphasizes that the Biacor 8S is a high-throughput screening platform, and that it integrates AI-powered data analysis.
And that right there is the commercial moat.
So,
if you are a massive pharma company, you don't want to test one molecule an hour. You want to screen tens of thousands of compounds a week.
right, you need scale.
So the Biacor 8S automates the physical handling of the samples, maximizing the throughput. But when you are running thousands of SPR tests, you are generating mountains of raw optical data.
Just terabytes of light refraction data.
Exactly. A human researcher would be completely paralyzed by the volume. So Danaher integrated artificial intelligence directly into the platform to analyze those binding kinetics instantly.
Flagging the most promising drug candidates autonomously.
Yes, it does the heavy lifting for the scientists.
They are essentially selling time. I mean, in the pharmaceutical industry, a drug patent has a ticking clock, right?
A very strict ticking clock.
If you can use AI and high-throughput screening to shave 6 months off your preclinical discovery phase, that translates to 6 more months of exclusive patent-protected commercial sales on the back end.
Which could be worth hundreds of millions of dollars.
No wonder labs are buying these systems.
Precisely. And we see a very similar dynamic with another product highlighted in the call, the Novus V55 from their SCIX operating company.
Okay, the transcript calls this an AI-enabled triple quadrupole mass spectrometry system.
It's quite a mouthful.
It is.
Yeah.
Now, mass spectrometry, if I remember my high school chemistry correctly, this is essentially a machine that figures out the exact chemical recipe of a sample by breaking it apart and weighing the pieces.
That is actually a very solid working definition, yeah.
Like taking a car apart and weighing the doors and the engine to prove it's a Honda.
That's a great analogy. Basically, you vaporize a sample and bombard it with electrons to turn the molecules into charged ions.
Okay.
Then you use magnetic or electric fields to accelerate those ions. Because heavier ions accelerate differently than lighter ones, you can sort them out and create a spectrum.
A highly precise inventory of exactly what is in the sample.
Right, based on the mass to charge ratio.
But what makes it a triple quadrupole? It sounds like a razor with 3 blades instead of 1.
It's conceptually similar in terms of adding precision. So a quadrupole is a set of 4 parallel metal rods.
Okay.
In a standard mass spectrometer, you have one set of rods that acts as a filter, only letting ions of a specific weight pass through to the detector.
So a triple quadrupole has 3 stages.
Exactly. The first quadrupole selects a very specific target ion. The second quadrupole is a collision cell. It literally smashes that target ion into smaller fragment ions using an inert gas.
And then the third.
The third quadrupole then analyzes those specific fragments.
So it's not just finding the needle in the haystack. It's finding the needle, breaking the needle in half, and analyzing the molecular structure of the steel inside the needle.
Yes. To prove it was manufactured in a specific factory.
The specificity must be incredible.
The sensitivity is unparalleled. It is used heavily in toxicology, environmental testing for trace pollutants like PSAS in drinking water, and clinical diagnostics.
Like looking for parts per trillion of a specific biomarker in a blood sample.
Exactly. And again, SCIX layered artificial intelligence over the data output.
Of course they did.
The AI optimizes the instrument's performance, it calibrates it in real time, and it interprets the complex fragment data faster than a human technician could.
They're delivering higher sensitivity with lower operating costs.
Which is exactly what laboratory directors are demanding in the current macroeconomic environment.
Speaking of clinical diagnostics and searching for biomarkers, there was an announcement from Beckman Coulter, another Danaher company, that I found just staggering from a purely human perspective.
Oh, the Alzheimer's tests.
Yes. They introduced 2 new blood-based biomarker tests for Alzheimer's disease, specifically targeting a protein called PTAU217.
This represents a monumental paradigm shift in how we approach neurodegenerative disease. It really does.
Because if we look back at the last 2 decades of Alzheimer's research, it has been a notoriously difficult field, largely because diagnosing the disease accurately in living patients was incredibly burdensome, right?
Yeah, incredibly burdensome.
Because you couldn't just look at a simple X-ray and see Alzheimer's. You had to rely on cognitive memory tests, which are subjective.
And those memory tests usually only show severe impairment after the brain has already suffered massive, irreversible damage.
Exactly. So how did they definitively diagnose it before this?
Well, the definitive pathological hallmarks of Alzheimer's are amyloid plaques and tau tangles accumulating in the brain tissue. For a long time, the only way to confirm their presence was either an autopsy after death, a highly invasive lumbar puncture to draw cerebrospinal fluid.
A spinal tap.
Right, a spinal tap. Or a positron emission tomography, a PET scan of the brain.
And PET scans are not exactly accessible. I mean, you have to inject a patient with a radioactive tracer. They're incredibly expensive, and many regional hospitals don't even have the equipment.
Sure.
Not to mention, most elderly patients are going to refuse a spinal tap unless it is absolutely critical.
Which meant millions of people were going undiagnosed or diagnosed too late for any medical intervention to be effective.
So how does this new blood test change that?
Well, the discovery that fragments of these toxic proteins, specifically phosphorylated tau217, actually cross the blood-brain barrier and circulate in the bloodstream changes everything.
They leak into the blood.
Yes. Beckman Coulter has developed an assay that is sensitive enough to detect those microscopic trace elements of PTAU217 from a standard venous blood draw.
That is just incredible. You go to your general practitioner, they take a vial of blood, just like they are checking your cholesterol, and they can screen for Alzheimer's pathology.
Exactly. And the transcript noted they just received a CE mark for one of these tests.
What does the CE mark mean in this context?
A CE mark signifies that the product meets the safety and clinical performance standards required to be sold within the European Economic Area.
So it's a major regulatory hurdle cleared, allowing them to commercialize the diagnostic test across Europe immediately.
It is. But the business genius here, the real reason this drives Danaher's bottom line is how the test is actually deployed.
Right. The transcript specifically mentions these new assays are designed to run on the DXi 9000 immunoassay analyzers.
This is the classic razor and blade business model executed flawlessly.
Explain that.
Danaher has spent years installing these massive DXi 9000 machines in hospital laboratories around the world. The hospitals have already spent the capital to buy hardware. They've already trained their staff on how to use it.
So when Beckman Coulter invents a revolutionary new Alzheimer's test, they don't have to convince the hospital to buy a new $2 million machine to run it.
No, they simply sell them the chemical assay kits, the high-margin consumable.
The blades for the razor.
Exactly. The hospital loads the new kits into the machine they already own, and they instantly expand their diagnostic capabilities.
That installed base of instruments creates an impenetrable competitive moat. I mean, a startup might invent a slightly better Alzheimer's test, but they will never convince thousands of hospitals to rip out their Beckman Coulter machines and buy unproven hardware just to run it.
Never. That structural advantage is why their life sciences division is accelerating.
But we have to address the elephant in the room now. We have to talk about the bioprocessing division.
Right, the miss.
Because as much as the instrument portfolio is soaring, bioprocessing hit a wall this quarter. This was the focal point of the Q&A session with the Wall Street analysts.
It absolutely dominated the conversation.
Let's look at the numbers. Danaher reported that core revenue in bioprocessing grew in the low single digits. But the consumable side of the business heavily missed internal expectations.
Yeah, that was a tough pill for the market to swallow.
Michael Riskin, an analyst from Bank of America, really pushed management on this. He calculated that the Q2 miss was roughly $75 million and that the full-year guidance for bioprocessing was being quietly adjusted down by about $150 million.
Right, and the CFO, Matt Cogino, stepped in to refine those numbers slightly, noting it was more of a $50 to $60 million headwind for the quarter and a little over $100 million for the full year.
But the exact dollar amount is secondary to the psychological impact, right?
Oh, completely. In the world of high-growth biomanufacturing, any sign of slowing revenue triggers visceral panic among institutional investors.
And it makes sense why they would panic. For the last 2 years, the biotech sector has been suffering through this brutal destocking phase.
Your COVID hangover.
Exactly. During the pandemic supply chain crisis, pharmaceutical companies were terrified of running out of supplies, so they hoarded massive amounts of inventory in their warehouses.
And then when the crisis ended, they stopped buying new supplies for over a year while they slowly burned through their stockpile.
Right. And the market thought that destocking phase was finally over.
They really did.
So when Danaher suddenly reports a $60 million miss in consumables, the immediate fear is that we aren't just destocking anymore. The fear is that underlying end market demand for biotech drugs is actually collapsing.
Which is why Riskin practically demanded to know if this was a multi-quarter rebase.
But Danaher's CEO, Rainer Blair, was remarkably calm on the call. He didn't blame destocking, and he certainly didn't cite demand destruction.
No, he blamed the entire miss on customer project timing.
Specifically, he said a few massive commercial drug manufacturers pushed back shipments of chromatography resins into 2027 because of site readiness challenges.
This is where we need to translate corporate speak into operational reality. To understand why a customer would delay a shipment and why Rainer isn't panicking, we have to look at how modern biologic drugs are actually manufactured.
Right, because we aren't talking about stamping out aspirin pills in a chemical press here. Biologics are living medicines.
They are incredibly complex. Monoclonal antibodies for treating cancer or autoimmune diseases are synthesized by living cells.
Usually Chinese hamster ovary cells, right?
Yes. Usually CHO cells, grown inside massive stainless steel vats called bioreactors. You feed the cells, and they act as microscopic factories, secreting the therapeutic drug into the surrounding liquid.
But when that process is done, you don't just bottle the liquid. I mean, it's a toxic soup of living cells, dead cells, waste proteins, and the drug itself.
Exactly. You have to purify it. And that is where chromatography comes in.
Okay, walk me through chromatography.
Downstream purification is often the most expensive and complex part of biomanufacturing. A chromatography column is essentially a massive, highly engineered cylinder packed with a specialized resin.
And what does the resin look like?
It looks like microscopic beads, but chemically, those beads are designed with specific ligands-binding agents that act like chemical magnets.
So you pour the bioreactor soup through the column, and the resin magnetically grabs onto the cancer drug, but lets all the cellular waste wash right through.
Precisely. It is affinity chromatography. Once the waste is flushed away, you change the pH or the salt concentration of the buffer liquid in the column, which breaks the magnetic bond.
And then the pure drug detaches from the resin and washes out the bottom into a sterile collection bag.
Exactly. It's a brilliant process.
That makes perfect sense. So these resins are mission critical, but Rainer noted that these delayed shipments were worth $10 to $30 million per shipment.
Yeah, that's a massive price tag.
Why on earth does a tank full of microscopic beads cost $30 million?
Because the chemical engineering required to manufacture resin that performs with perfect consistency, batch after batch, without degrading or leaching toxins into the drug supply, it is astronomical.
And I'm assuming for commercial manufacturing, you need a lot of it.
Exactly. For large commercial runs, these columns are massive. We are talking about hundreds of liters of highly specialized resin.
Okay, so a pharmaceutical company has ordered $30 million worth of this resin from Danaher. Why call up and say, don't ship it yet?
Because of the phrase Rainer used. Site readiness challenges.
The factories aren't built.
Right. Building a new biomanufacturing facility, a greenfield project, is a multi-year, multi-billion-dollar endeavor. You are constructing ISO-certified clean rooms, installing miles of orbital welded stainless steel piping, and integrating complex HVAC systems that completely recycle the air every few minutes.
And I assume the regulatory oversight on that construction is intense.
It is absolute. Every single valve, every single sensor, every square foot of the clean room has to undergo strict validation testing to prove to the FDA that the facility can produce the drug safely.
So if a contractor is 6 months late installing the specialized plumbing,
or if the HVAC system fails a particulate test, the entire timeline of the facility grinds to a halt.
I see. And if your clean room isn't certified yet, the absolute last thing you want is $30 million worth of highly sensitive temperature-controlled chromatography resin sitting on a loading dock or in a dusty construction zone.
Exactly. You tell Danaher to keep it in their climate-controlled warehouse until your facility is actually permitted to open its doors.
That fundamentally changes the narrative of the earnings miss. It isn't lost revenue, it's deferred revenue.
Entirely deferred.
But how can Reiner be so confident that a competitor won't swoop in during this delay and offer the pharma company a cheaper resin? Because he kept using the phrase that Danaher is spec'd into these molecules.
The concept of being spec'd in is the ultimate competitive moat in the biomanufacturing supply chain.
How does it work?
When a pharmaceutical company invents a new biologic drug, they have to file a chemistry, manufacturing, and controls, or CMC application with the FDA.
So the FDA doesn't just approve the drug. They approve the exact recipe for how it's made.
Yes. The FDA's mandate is safety and efficacy. Because biologics are so complex, even a microscopic change in the manufacturing process could theoretically alter the physical structure of the drug, making it less effective or even dangerous.
Right.
So, during the phase 3 clinical trials, if the pharma company uses a specific Danaher chromatography resin to purify the drug, they must write the exact serial number and brand of that Danaher resin into the FDA application.
Oh, wow. So they lock themselves into Danaher's ecosystem by law?
They are legally tethered. Once the FDA approves the drug, the pharma company cannot simply switch to a cheaper generic resin from a competitor.
What happens if they try to?
If they want to change the resin, they have to run new validation studies, prove comparability to the FDA, and essentially file a massive regulatory amendment. The cost and time required to do that almost always outweigh the savings of buying a cheaper resin.
Which means once Danaher gets spec'd into a blockbuster drug during the clinical phase, they essentially have a government-enforced monopoly on supplying that resin for the entire 10 to 15-year life cycle of the drug patent.
Exactly. That is why Reiner Blair did not sound panicked on the call. He knows the $100 million delay is secure.
It's guaranteed money, just arriving later.
Right. And more importantly, he provided a crucial data point to back up his confidence. Despite the revenue miss, underlying orders for bioprocessing consumables still grew in the mid-teens during the quarter.
The order book is growing. That's huge because revenue is a backward-looking metric based on when a product ships.
Exactly. Orders are a forward-looking indicator of demand. If orders are growing in the mid-teens, the pipeline is flush. The customers are actively booking future capacity.
And that forward-looking demand ties directly into a point brought up by Tycho Peterson, an analyst at Jefferies. He noticed that bioproduction equipment revenues actually grew this quarter. He asked if we are finally seeing a turn in the equipment cycle, potentially driven by reshoring.
Reshoring is a fascinating macro trend right now. We spent the last 3 decades globalizing our supply chains, moving all our manufacturing to Asia to save on labor costs.
And the pandemic brutally exposed the fragility of that model.
Completely. When borders closed and shipping lanes locked up, Western governments realized they were entirely dependent on overseas factories for life-saving antibiotics, basic generic drugs, and the raw materials needed for biologics.
It became an urgent national security issue overnight.
Which led to massive government incentives, like the executive orders on biomanufacturing in the U.S., to bring that capacity back home.
Yes. And Reiner confirmed they are seeing significant capital expenditure in this area. He differentiated between 2 types of projects. First, he mentioned brownfield expansion.
A brownfield project involves taking an existing, already permitted manufacturing site and expanding it, adding a new wing, upgrading the bioreactors, things like that.
Those can happen relatively fast because the basic infrastructure and regulatory groundwork is already laid.
Exactly, and that rapid expansion is what's driving the current uptick in equipment revenue. But Reiner also mentioned they are quoting on greenfield investments,
which are the massive multi-year projects we just discussed, building entirely new facilities from scratch on empty plots of land.
Right. The fact that they are actively quoting on new greenfield projects signals that the pharmaceutical industry is at the very beginning of a multi-year structural infrastructure boom.
They are physically rebuilding the global supply chain, and Danaher's supplying the blueprints and the hardware.
It is the classic selling shovels during a gold rush dynamic, but magnified by geopolitical necessity.
Okay, we've covered the organic growth and the bioprocessing dynamics. Now I want to look at how Danaher is deploying that $1.3 billion in free cash flow, because they are highly aggressive on the mergers and acquisitions front.
They really are.
They closed a major acquisition of a company called Massimo early in June, and they announced a pending acquisition of STATLab. Let's start with Massimo.
Massimo is a very strategic expansion for Danaher into the patient monitoring and acute care space. The transcript notes they are off to a great start, delivering high single-digit revenue growth.
But the piece of information that really stands out is Massimo's recent FDA 510(k) clearance for an AI-enabled opioid-induced respiratory depression detection solution.
opioid-induced respiratory depression. This is the physiological mechanism of a fatal overdose, right?
Yes. The opioids suppress the central nervous system to the point where the brain literally forgets to tell the lungs to breathe.
And it is a massive risk, not just in the ongoing public health crisis, but also in clinical settings.
Really? Like in a hospital?
Oh, absolutely. When a patient is recovering from major surgery in a hospital and is placed on aggressive opioid pain management, they are very vulnerable. Traditionally, a nurse might check their vitals every few hours.
But respiratory depression can onset rapidly.
Yes. So how does Massimo's technology change that?
They utilize continuous non-invasive monitoring. They use advanced pulse oximetry to track the oxygen saturation in the blood and capnography to measure the carbon dioxide being exhaled.
But they don't just display those numbers on a screen, do they?
No, they feed a continuous stream of physiological data into a proprietary artificial intelligence algorithm.
Let me guess. The AI is trained on millions of hours of patient data to recognize the subtle microscopic changes in breathing patterns that precede a catastrophic event.
Exactly. The algorithm detects the degrading trajectory long before a human clinician would notice the trend line shifting. It predicts the respiratory depression and triggers an alarm,
allowing the clinical team to rush in and administer an antagonist like naloxone or adjust the pain medication before the patient stops breathing.
It is literally predictive life-saving technology.
That is an incredibly powerful tool for a hospital system. But what's equally interesting to me is how quickly Danaher integrates these acquisitions.
Right. Reiner mentioned they have already completed their first operating review of Massimo using the Danaher Business System Launch Excellence tool.
The Danaher Business System, or DBS, it gets referenced in almost every piece of literature about this company.
What makes it so special?
DBS is the foundational DNA of the corporation. It's heavily inspired by lean manufacturing principles, specifically the Toyota production system, which focuses on eliminating waste and continuous improvement, or Kaizen.
But Danaher didn't just apply lean principles to factory floors.
No, they adapted them to every single function of the business. R&D, human resources, supply chain logistics, and sales.
So when they acquire a company with brilliant technology but maybe inefficient management, they immediately inject DBS into the culture.
They deploy specialized teams to map out every workflow, identify inefficiencies, and strip out unnecessary costs. They systematize innovation.
They use DBS tools to accelerate the timeline of bringing new products, like Massimo's opioid detection algorithm, to a broader global market.
And the results speak for themselves. The CFO noted that despite only closing the deal in June, Massimo is expected to contribute 7 to 8 cents to earnings per share this year.
They are making massive acquisitions instantly accretive to the bottom line. Which brings us to the second acquisition, StatLab.
StatLab is a textbook example of strengthening a recurring revenue moat. It is currently a pending acquisition expected to close by the end of 2026, and it's being acquired under the umbrella of Leica Biosystems, which is one of Danaher's existing operating companies.
The transcript notes, StatLab is a leading manufacturer of consumables across the anatomical pathology workflow. Let's break that down. Anatomical pathology is essentially the study of diseased tissue, right? Biopsies.
Yes. When a surgeon removes a suspicious tumor or a dermatology clinic biopsies a mole, that physical tissue is sent to an anatomical pathology lab to determine if it is cancerous.
And Leica Biosystems is already a titan in this space. They make the massive capital equipment.
Right. They make the tissue processors, the microtomes that slice the tissue samples into incredibly thin sections, and the advanced digital pathology scanners that digitize the slides so a pathologist can view them on a 4K monitor instead of hunching over a microscope.
Leica builds the structural hardware of the modern pathology lab. But hardware is a cyclical, one-time purchase.
A hospital buys a $1 million digital scanner, and they expect it to run for 10 years. If hospital budgets tighten during a recession, the first thing they freeze is capital expenditure. They will delay buying a new scanner for 2 years if they have to.
But they can't delay diagnosing cancer. The patients are still coming through the door.
Exactly. And that is where StatLab fits perfectly. StatLab doesn't make the machines. They manufacture the consumables.
The specialized chemical reagents used to preserve the tissue.
The hematoxylin and eosin stains used to dye the cells so the cancer is visible. The physical glass slides the tissue rests on.
Every single biopsy requires a fresh set of consumables. Leica is acquiring the company that supplies the daily fuel for their machines.
And the financial profile reflects that necessity. The transcript highlights that SETLAB generates roughly $250 million in annual revenue, but more importantly, it operates with a business model boasting more than 85% recurring revenue.
85% recurring revenue. That is the holy grail for corporate valuation.
Wall Street will pay massive premiums for a company with that level of predictable cash flow because it is entirely insulated from macroeconomic shocks.
Danaher is taking their massive free cash flow and using it to buy even more resilient cash flow streams. It's a compounding loop.
It is brilliant capital allocation. They expect SETLAB to grow at a high single-digit rate over the long term and be accretive to adjusted EPS in the very first full year.
Okay, let's pivot slightly and look at the geographic dynamics, because you cannot analyze a global healthcare company without talking about China. For the last couple of years, China has been a brutal environment for Western medical device and life science companies.
It has been a perfect storm of headwinds. You had massive geopolitical tensions, sweeping anti-corruption campaigns within the Chinese healthcare system that completely froze hospital procurement.
And the aggressive rollout of VBP.
Yes, VBP, volume-based procurement.
This is essentially the Chinese government flexing its monopolistic buying power to crash prices, correct?
That's a blunt but accurate way to look at it. Under VBP, the State Health Administration bundles the demand of thousands of public hospitals together and puts out a tender for a specific medical product, say, a diagnostic assay.
So the government says, we will guarantee the winner of this bid an enormous exclusive volume of sales across all our hospitals.
But the catch is a brutal price war, a race to the bottom.
In order to win that guaranteed volume, multinational companies have had to slash their prices by 50, 60, sometimes 80%, devastating their profit margins in the region.
For a while, VBP was destroying the earnings of Western medtech companies operating in China.
But the narrative in this transcript is shifting. Reiner mentioned that core revenues in high-growth markets increased more than 10%, with mid-single-digit growth specifically in China.
He noted that the declines tied to VBP began to moderate as pricing stabilized and volumes improved.
What we are seeing is the elasticity of demand taking over. The initial shock of the price cuts has been absorbed into the baseline financials.
But because the prices of these diagnostic tests are now vastly cheaper, the Chinese healthcare system can afford to run millions more of them.
The sheer volume of tests being conducted is now offsetting the lower price per test, driving the division back into positive growth.
The storm is passing. Reiner also made a point to mention that local Chinese biotech companies are heavily partnering with Cytiva on developing novel molecules.
So despite the geopolitical friction between Washington and Beijing, the underlying demand for cutting-edge healthcare infrastructure in China is insatiable, and Danaher's technology is too deeply embedded for them to be locked out.
Absolutely. The science transcends the politics in many of these high-stakes therapeutic areas.
Before we move to the guidance, I want to touch on one more end market that stood out. Jack, an analyst on the call, asked about Paul Industrial, which is a division of Danaher.
They posted an impressive 10% growth in the quarter.
Where is that coming from? Because Reiner specifically cited microelectronics and semiconductors. I honestly forget sometimes that Danaher operates outside of biology.
Paul is a global juggernaut in high-tech filtration and separation sciences, and while they do heavy work in biopharma, their industrial arm is critical to semiconductor manufacturing.
How does filtration tie into microchips?
Making an advanced semiconductor, especially the cutting-edge nodes driving the AI revolution, is an exercise in extreme purity.
Like clean room purity.
Even cleaner. The photolithography process, where microscopic circuit patterns are etched onto silicon wafers using extreme ultraviolet light, requires ultra-pure water, specialized photoresis, and complex chemical slurry.
I imagine even a microscopic impurity could ruin a chip.
If a single subnanometer particle of dust or a stray metallic ion makes it into the chemical slurry, it acts like a boulder crashing into the microscopic circuitry.
It ruins the entire silicon wafer, which can cost tens of thousands of dollars.
Paul manufactures the mission-critical filtration systems that remove impurities down to the molecular level, ensuring the yield rates of these semiconductor fabs remain profitable.
And with the absolute explosion in AI hardware demand and the global race to build new, advanced semiconductor fabrication plants in the US and Asia, Paul is perfectly positioned to capture that capital expenditure.
Reiner even mentioned they are in the startup phase of a new plant in Singapore to serve the Asian semiconductor hubs.
It highlights the hidden diversity of Danaher's portfolio. They are riding the secular tailwinds of the biotech revolution and the AI hardware revolution simultaneously.
Which brings us to takeaway number 3. management guidance.
We know they are confident, but let's look at exactly what they're forecasting for the back half of 2026. Management raised their full-year adjusted EPS guidance to a range of $8.45 to $8.60.
This is a solid bump from their previous expectations. Now, as the CFO explained, a significant portion of that raise, about 7 to 8 cents, is mechanically driven by the early closure of the Massimo deal, adding to the bottom line.
But Vijay Kumar from Evercore pushed back on that. He essentially asked the CFO, look, if Massimo is giving you 8 cents, and you fundamentally beat expectations across your core business in Q2, shouldn't your full-year guide be even higher? Are you sandbagging the numbers?
It was a very fair question. Matt Cogino's response was essentially a masterclass in conservative corporate forecasting.
He admitted that they intentionally baked in a degree of macroeconomic hedging for the second half of the year.
There are always variables outside of their control: foreign exchange rate fluctuations, shifting interest rates impacting biotech funding, or unexpected geopolitical supply chain snags.
They would rather set a realistic, highly achievable bar and step over it, rather than forecast absolute perfection and risk stumbling.
Under-promise and over-deliver. But even with that built-in conservatism, Matt noted that at the midpoint of their new guidance, they're projecting nearly 10% earnings per share growth for the entire year.
Generating 10% bottom line growth on a multi-billion-dollar base in this economic climate is remarkable. Now, the top-line revenue guidance for Q3 is where retail investors skimming the headlines might get spooked. Management projected Q3 core revenue growth of only 2 to 3%.
But again, context is everything. Matt explicitly quantified the ongoing drag from respiratory testing. He stated that in Q3, the respiratory headwind represents a massive 250 basis point drag on overall growth.
So we go back to the floodwater analogy. The final wave of pandemic-era testing revenue is still washing out of the year-over-year comparisons.
If you look at the foundational core business, excluding that specific respiratory decline, management expects it to grow at a very healthy 5% in the third quarter.
And the trajectory only improves from there. By the fourth quarter, the year-over-year comparisons normalize. The respiratory drag effectively vanishes from the math.
As a result, management expects to exit the year with the total reported revenue growth matching the core growth at a mid-single-digit rate. The mathematical headwinds are clearing, allowing the true operational strength of the portfolio to shine through.
Which perfectly tees up our final takeaway. The bottom line. What is the ultimate actionable signal for an investor analyzing this quarter? You telegraphed your stance early on, and everything we've discussed supports it. This is a highly bullish quarter disguised by noisy, temporary headwinds.
It is a study in resilience and operational excellence. We are looking at a company that managed to accelerate its core organic growth while navigating the final stages of a pandemic hangover and massive structural shifts in Chinese procurement.
We saw that the highly publicized bioprocessing revenue miss was demonstrably a localized customer scheduling issue, heavily insulated by FDA regulatory lock-in and backed by mid-teens order book growth.
We saw an innovation engine firing on all cylinders, from AI-powered mass spectrometry to revolutionary blood-based Alzheimer's diagnostics that perfectly leveraged their existing installed base of hospital machinery.
And above all, we saw a financial compounding machine generating 124% free cash flow conversion, allowing them to aggressively acquire high-margin, recurring revenue assets like StatLab without straining their balance sheet.
But if you don't want to rely on our analysis, you only need to look at management's own capital allocation.
The most definitive, actionable signal from this entire transcript is the $900 million share buyback executed during the quarter. They retired 5 million shares of their own stock.
The psychology and the math of a share buyback at this scale are critical to understand. Corporate executives have teams of analysts running rigorous discounted cash flow models on their own internal projections.
They know exactly what your future pipeline looks like.
They do not authorize a billion-dollar open market purchase of their own stock unless those models unequivocally prove that the public market is fundamentally undervaluing the company's true intrinsic worth.
It is the ultimate expression of conviction. And mathematically, by permanently retiring those 5 million shares, they shrink the total pie.
Even if the company's overall net income stays exactly the same, the earnings per share mathematically increases for every remaining investor because the profits are divided among fewer shares.
It is highly accretive. When a management team drops $1 billion on their own equity while simultaneously raising forward guidance, they are screaming to the market that their competitive moat is unbreachable And their stock is cheap.
It aligns perfectly with the narrative of a company exiting a transitional period and entering a new phase of compounding growth.
We have unpacked the accounting, the biology, the global supply chains, and the strategic M&A. We have mapped out exactly how Danaher operates. But before we sign off, I want to circle back to a concept you mentioned earlier.
The autonomous labs.
Yes, you highlighted a specific comment Rainer Blair made regarding the Beckman Life Sciences division. Something about the future of automation. And it feels like the perfect macro thought to leave everyone with.
Yes. When discussing the growth drivers in the life sciences portfolio, Rainer noted that customers are increasingly investing in lab infrastructure to support what he called autonomous labs and AI-enabled drug discovery.
Autonomous labs. We touched on AI screening earlier, but autonomous implies something much larger. You're talking about entire facilities operating without human researchers.
We are rapidly approaching the era of the lab in a loop. I want you to visualize the pharmaceutical research facility of the near future. Instead of a lab bench lined with scientists pipetting liquids into test tubes, you have a fully enclosed, highly sterile environment.
Okay, an artificial intelligence algorithm generates a hypothesis for a novel molecular structure that might cure a specific autoimmune disease.
Then, without human intervention, automated robotic arms and microfluidic systems physically synthesize that chemical compound.
The robotics transport the newly created sample into an SPR machine like the Cytiva Biacor 8S or a mass spectrometer like the SEIX Novus V55.
The instrument tests the molecule, analyzes the binding kinetics and the mass profile, and instantly feeds that massive data set back into the central AI.
The AI analyzes the failure or success of the test, learns from it, tweaks the molecular blueprint, and instantly commands the robots to build the next iteration.
Exactly. It is a continuous self-optimizing feedback loop. It never sleeps. It doesn't take weekends off. It doesn't experience human fatigue or pipetting errors.
It runs 24 hours a day, 7 days a week, rapidly iterating through thousands of compounds until it finds the optimal therapeutic candidate.
That sounds like science fiction, but based on this transcript, Danaher is actively selling the foundational hardware and software to build these facilities today.
And that brings up an incredible financial implication. If these robotic AI-driven labs are operating 247 at speeds no human could ever match, the sheer volume of experiments they're conducting is going to go exponential.
Which means the consumable burn rate goes exponential.
Wow. The chemical reagents, the specialized glass slides, the assay kits, the chromatography resins. Every single time the robotic loop runs an experiment, it consumes a product manufactured by Danaher.
And as we discussed with the StatLab acquisition, these consumables represent highly profitable 85% recurring revenue.
The faster the AI thinks, the faster the robots move, and the more rapidly the labs burn through Danaher's most profitable inventory.
Danaher is not just a healthcare conglomerate. They are positioning themselves as the foundational infrastructure play on the artificial intelligence revolution in biology.
What an incredible paradigm shift to end on. The diagnostic muddy waters we started with have completely cleared. By digging into the actual mechanics of what Danaher builds and how their customers operate, we've seen that the temporary financial noise is masking a company laying the groundwork for a radically advanced future.
It's been a great analysis.
This has been a deeply illuminating Talk Tickers breakdown. Thank you all for tuning in and navigating the complexities of the global scientific supply chain with us. Keep a close eye on those autonomous lab trends. Watch how that bioprocessing order book translates into revenue in the coming quarters. And as always, keep analyzing, keep questioning, and keep diving deeper. We'll catch you on the next deep dive.